Hey there, I am Jeff Reeves, the editor of InvestorPlace.com. I'm talking with Charles Sizemore, who is the editor of the Macro Trend Investor newsletter. Charles, your strategy is good not just in today's market, but in every market, because you look at kind of long-term, durable macro trends that people can believe in. So give me a couple kind of macro, big-picture things that investors can look at, and more importantly, how they trade them. What's on your mind right now?
You bet. Now, one macro trend I have followed forever and will follow forever because it is so predictable. It's like death and taxes. There's no way you can get around it. It's just demographic trends. You know, when someone is born, that 5 years later they're going to be in kindergarten. 18 years later they're going to be getting out of high school. I mean, it is predictable like clockwork. So with that said, we have an aging America. What does that mean? It means we have all of the diseases associated with old age, one of which is, of course, kidney disease. One of my favorite plays there is DaVita, one of the largest dialysis providers in the world, and also, I might add, a holding of Warren Buffett's Berkshire Hathaway.
Yeah, and unlike some of the other medical stocks this year, I mean, biotech kind of imploded, but DaVita has outperformed the market, right, this year?
Well, it has, and part of the reason is their income stream is very predictable. Once you're on dialysis, you're not going anywhere. I mean, I don't want to be flippant, but it's true. When you're in that situation, when you have chronic kidney disease and you're on dialysis, you are a patient until you either get a transplant or until you die. I mean, that's how that works. So their income stream is very predictable, very reliable.
Yep, reliable this year. I think it's up 7.5% in 2014, and definitely a good long-term play. Looking beyond healthcare, kind of what are the other big trends that you see going on in the U.S. right now, particularly in the capital markets?
Sure. Remember at the beginning of this year, everyone was talking about, oh, interest rates are rising, yields are rising across the yield curve. We're going to see the 10-year Treasury at 4% before too long. I knew that wasn't going to happen for a couple reasons. I was very adamant about this. I was screaming till I was blue in the face on this. When you get out of a credit bubble like we had, it's not realistic to see rising yields this quickly after. Yes, it's been 5 or 6 years, I get that, but if you look at historical credit bubbles there, it takes a lot longer for those excesses to be completely wiped clean. You still have the financial sector. It's not really deleveraging like it was a few years ago, but it's not really levering up again either. Even the federal government, the spendthrift federal government, their budget deficit is shrinking. So you have all of these factors, plus, going back to demographics, you have this big, unending demand for yield as the baby boomers age. They themselves and investment managers that invest on their behalf, mutual fund managers, pension fund managers, what have you, they're hunting for yield. That should keep a lid on bond yields for the foreseeable future. So with that said, I like mortgage REITs. Mortgage REITs got absolutely slaughtered last year. I love those as a pick this year for a couple reasons. One, they have a high yield that should do well in a prolonged environment where yields are low. Those mortgage REITs should do just fine. And two, industry-wide, mortgage REITs were selling at a discount to their underlying mortgages. Like, you could actually hypothetically buy a mortgage REIT outright, break it up into pieces, and sell it off for a profit. It's hard to lose money when you can do that. So those conditions are still in place today. So I highly recommend mortgage REITs as well.
So for a little bit of an aggressive investor like me out there, income is nice, and I certainly do like the long-term trend. But if I want a little sexier play, something that has significant growth and upside, where can I look right now? We're kind of sluggish right here in America, and I don't trust tech. Where am I going to go?
Sure. Emerging markets. Emerging markets are a pariah asset class, and they have been for the last several years. Most emerging markets are down over the last 3 years. While the U.S. market has been shooting to the moon, a lot of these emerging markets they've had year-over-year declines for 2 or 3 years running. One of my favorites, a market that looks to me to have bottomed out a few months ago and has been performing very well, is Turkey. I'm long Turkey via the iShares Turkey ETF. I think that is a fantastic place to be right now. Turkey, sort of long-term, the big picture view there is Turkey is to Europe what Mexico is to the United States. It's a large population emerging market right on their doorstep. Good supply of labor, good supply of low-cost manufacturing. It's an up-and-coming country. It's a bridge to Asia. Well, Mexico is not a bridge to Asia, of course, but that's where Turkey kind of goes in some way there. Turkey is a bridge between Europe and Asia. It is just it's a fantastic long-term macro play, and right now the stocks are cheap, and investors are just now starting to recognize that.
Well, there you have it. Those are definitely some big picture trends. We're not just kind of looking at fad stocks at the moment here. So if you want to learn more about these kind of durable long-term macro trends, check out Charles's newsletter, Macro Trend Investor. And in the meantime, Charles, we'll talk some more and get some more picks up there for people so they can get a taste of what you're doing.
Sounds like a plan.